Now, a challenging week for many investors in stocks and commodities. My guess says that when it comes to equities, we could see some more gains, but that this rally might be one to sell into rather than add to your positions. We're going to find out more about this. We're joined by Scott Meinert. He's the Chief Investment Officer at Guggenheim Partners. Guggenheim managing about $100 billion worth of assets. Scott Meinert, always a pleasure to have you. Thanks so much for coming in. So there is a trifecta at work you've described. One is you do not see broad-based inflation. That's number one. Higher or at least elevated levels of unemployment, number two, and a Fed that is keeping interest rates near zero. What does that trifecta tell you about the future for investments?
Well, what it tells you, Pimm, is that the environment is very favorable for equities in the long run. A lot of the concerns that people have about a sudden skyrocketing of interest rates, predictions of 5%, 6%, 7% 10-year notes are just not on the cards. And it tells you that the Fed is going to give the economy time to heal, especially in the housing sector. Given the overhang in housing, 14 million unsold units if you count the shadow inventory, it's going to take years to clean this up. And what we saw when mortgage rates backed up a couple of months ago is housing sales activity fell. Now that rates have started to move lower again, housing activity is picking up, and the Fed knows this formula. All
right, now when you look at interest rates, when you describe them, we're at, let's say for the 10-year, you loan your money to the government for 10 years, they'll give you 3.16%. You think it can go lower?
Yeah, I do. Not that I'm recommending our clients get long a lot of interest rate risk now, but if you look at the history of rates and you see what happens at the end of recessions, traditionally the Fed does not start raising rates until at least 3 years after the end of the recession. We're now about 24 months out from the end of the recession, so we have at least another year probably before the Fed starts to move. The other thing is that there's a historical relationship between the Fed funds rate and the 10-year note, and that is that the 10-year note rarely gets more than 375 basis points, or call it 4%, above the overnight rate without having a rally. So the reality is that the Fed is on hold, well then the long-term rates are going to stay on hold too. And then given the fact that the Fed governor may be correct, that the price inflation we see is transitory, and we're starting to see it flow through in commodity prices and other things, we actually might see lower levels of inflation 6 months from now than what we're seeing today.
Is it possible that when he does raise interest rates, when Ben Bernanke finally says, all right, 0%, that's not good, that the increase is going to be greater than we typically would expect? It's not going to be a quarter point here, a quarter point there, that it's going to be substantial because it's going to have to deal with, at that time, greater economic growth and greater inflation?
Well, I think the Fed is going to be very cautious in how it takes back the liquidity. I think they're concerned about that scenario that we've talked about before in the Great Depression between 1936 and 1937, when after 3 years of easy money, the economy had grown for 3 consecutive years between 33 and 36. Unemployment had fallen from 25 to 11%. The Fed began tightening at the same time that fiscal austerity came into play, and unemployment skyrocketed from 11 to 20%. And Dr. Bernanke is a student of history. He knows all this.